Welcome to this very special edition DCREC podcast series, sponsored by the Defined Contribution Real Estate Council, an organization passionate about providing American workers a financially secure retirement by investing in commercial real estate. And now, here is today's host, Todd Schnick.
Good morning, and welcome back to the special edition DCREC briefing. I'm your host, Todd Schnick. I am joined again by my friend David Skinner, a former co-president and current executive board member of DCREC. Good morning, David. How are you?
Todd, I'm doing great. Thanks for having me back for the next series of questions.
Yeah, no, I appreciate you making time to do it. So last time, David, we talked about why defined contribution plans should be using commercial real estate, and then we talked about the benefits of investing in commercial real estate. On today's show, we're going to dive into this a little bit deeper. So let me tee off this conversation by asking, so how can a defined contribution plan sponsor actually access commercial real estate?
Todd, that's a good question. It's a question we're frequently asked by plan sponsors, especially those who are not familiar with commercial real estate. And commercial real estate can be accessed through both the private and public markets via different platforms, including direct property investments, unlisted property funds, and listed real estate securities, including REITs. How real estate can be incorporated in a diversified investment portfolio really depends upon each investor's risk tolerance, their time horizon for investing, as well as their liquidity needs. While both types, listed and unlisted real estate, offer long-term diversification benefits, they both offer a little different outcome-generated benefits. So listed real estate securities like REITs are generally used in portfolios where investors have longer investment time horizons, a higher tolerance for volatility, and a need for higher absolute returns. Whereas private real estate, through direct property ownership, can be used by investors who are seeking to reduce volatility and returns within an overall investment portfolio, and really help increase the overall diversification of that portfolio.
Yeah, we talked last week about how important that is. So I'm better understanding how a plan sponsor can access real estate, but let's go a step further, David, and help me understand how a defined contribution plan sponsor can incorporate real estate into their plan.
Right. Well, let's start off with listed real estate securities first. It can be added as a standalone option to a plan menu. It could also be included in outcome-driven structures such as global growth structures, real asset or inflation protection strategies, as well as within target date funds and risk-based funds. An investment in direct real estate, Todd, where your money is buying the actual properties themselves, is a great way to add diversification for a target date, risk-based fund, inflation protection strategy, or real asset fund. Additionally, a case of using a blended strategy between the two structures can be made for investors to take advantage of combining the complementary attributes of direct real estate and listed real estate securities to diversify the real estate allocations. For example, some target date fund managers may choose to have a higher allocation to listed real estate securities or REITs at the front end of their glide path, believing total return prospects over long term may enable participants to have enough time to recover from short-term market corrections and higher volatility. Conversely, those same target date managers may choose to allocate more to private real estate as plan participants move further down the glide path and closer to retirement to dampen volatility and enhance downside protection. In summary, we believe all plan sponsors should consider adding commercial real estate to their retirement plan savings for all the reasons mentioned above. How to implement this investment structure will really be dependent on the investor's risk tolerance, their time horizon, and liquidity needs. But overall, both structures could fit into the plan and should fit in based on what's important and the outcomes that a plan sponsor is seeking.
All right, good stuff. And David, I suspect as our DCREC briefing continues to evolve, we'll go deeper into all of these subjects. So that's all the time we have for this morning. This has been the DCREC briefing. On behalf of my guest, David Skinner, a former co-president and current executive board member of DCREC, I am Todd Schnick. We'll see you next time on the DCREC briefing.